Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a pretty significant report from Morgan Stanley Asia Limited. It's titled UW2, which translates roughly to China Musing's Anti-Involution, the Antidote and Root Cure. It just came out July 25th, 2025, and it really digs into China's current push against what they call involution. It compares it to the 2015-2018 supply-side reforms, points out the big challenges, and looks at paths for, well, systemic change. The report does see stronger policy signals, but it flags that this round of anti-involution, it's a lot more complex.
That's exactly right. And the core idea, the real insight, is that this involution, that state where everyone's competing fiercely, but it doesn't actually boost overall productivity, just kind of spirals inward. It isn't just about too much supply. The deeper problems are these distorted incentives at the local level and what the report calls a path dependency on investment for quick growth.
Right, this idea that they're sort of stuck in that investment-led model.
Precisely. So getting lasting results means more than just tinkering. It needs fundamental structural reforms, changing those local incentives, fixing the tax system, and, crucially, shifting the economy more towards consumption.
Okay, so that makes it sound strategically quite different from the 2015-2018 effort. How does that play out in practice? What's the difference in approach?
Well, the differences are pretty stark. For one, deflationary pressures feel more embedded now.
Yeah.
And also, a huge chunk of the overcapacity this time, we're talking maybe 50 to 90%, it's in these emerging sectors. And it's largely privately owned.
So you can't just use the old playbook of top-down administrative cuts like they did with state-owned enterprises back then.
Exactly. That limits the effectiveness of that approach.
Yeah.
So the shift now is more towards market-oriented methods, things like government-guided M&A, making clearer rules about new versus old capacity, maybe even encouraging innovative business models. Like they mentioned Umetrip's zero-commission platform as an example of trying to curb price wars by changing the competitive dynamic itself.
Interesting. So given all these moving parts and the complexity, what does progress look like in the near term? And, what's the bigger picture timeline?
Well, the report suggests moderate consolidation is probably more likely, maybe sooner, in upstream industries. Think coal, steel, places with some history of integration. But for downstream sectors, it predicts a pretty significant lag, maybe 3 to 8 months between the high-level policy talk and actual concrete plans at the industry level. And the whole process is expected to be, let's say, more winding, more circuitous this time around.
Okay, let's drill down a bit. You mentioned these deeper issues, distorted local incentives, path dependency. What's the core challenge there that stops a quick fix, something beyond just managing supply levels?
Right. The report really hits on this. The problem isn't just technical, like too many factories. It's systemic. It's embedded in how local governments operate. Their incentives often push them towards, short-term GDP wins via investment, not necessarily towards long-term efficiency or boosting household consumption. So getting to the root cause means changing those fundamental incentive structures and the fiscal system. Surface adjustments probably won't cut it for long.
So how does this all tie together for the outlook then? What are the key factors that will decide if this whole anti-involution drive actually manages to generate sustainable reinflation?
Connecting the dots, the report lays out sort of 4 possible scenarios. The best one, the optimal path, robust, sustainable reinflation, that really depends on 2 things happening together. You need more proactive measures to rebalance demand, plus faster progress on those structural reforms we talked about.
Like Social Security, you mentioned.
Yes. Social Security, how officials are evaluated, the cadre system, and the broader fiscal and tax setup. If you don't get movement on both fronts, the report warns progress will likely stay gradual. And, there's a risk things could even slip into deeper deflation.
And the report points to the upcoming 15th five-year plan, discussions starting this autumn, as a really critical moment for spelling out these necessary structural changes.
Absolutely. I think a key takeaway here is pretty clear. Real, lasting success against involution needs fundamental shifts. It's got to go way beyond just short-term measures.
So for you, the listener, maybe the core question to mull over is this. How quickly and how deeply can China's long-standing incentive structures and its fiscal system actually change to genuinely support consumption and market-driven efficiency? That seems to be the crux of achieving sustainable reinflation.